Welcome to Master Trader, where you learn simple market analysis to make money investing and trading in the markets. I'm Dan Gibby, Chief Options Strategist at Master Trader, and in this week's Chart of the Week, we're going to discuss two recent bull put credit spread setup trades that we did in our advisory letters, and I'm going to show you the exact setup and how Master Trader mirrors the option strategy with the charts to generate high probability weekly and monthly income. This is what we refer to as the Master Trader bullish money patterns. Every one of these are different flavors or pictures of bullish turns, and then we use multiple time frames to give us the additional confidence on how bullish that turn is and what type of stock or option strategy is the most appropriate in that circumstance. But in selling a bull put credit spread, the idea is simple. We're going to sell an out-of-the-money put under support in every one of these pictures. Then we're going to simultaneously purchase a further out-of-the-money put to limit our risk. And secondly, it's less maintenance required to put on the position at your brokerage firm. The difference of those two numbers is going to be a net credit. We put the trade on in one order, and the money that we receive is our potential maximum gain on the trade, which we receive 100% of as long as the stock closes above the short strike price at expiration. IYT is the transports ETF. We've been watching this for a while. It had a bullish breakout, but then failed as we have been experienced, the pullback in the broader markets and the uncertainty over trade wars, etc. This is a climactic buy setup, multiple bars down, far from its moving averages. We have a bottoming tail on major support, which is this prior low. We sold a 22 days to expiration. We're selling the way out of the money $176 put and then buying a $168 put, making it an $8 wide bull put credit spread. We're taking in 70 cents a share. The math on that for your potential gain, the 70 cents a share you put in your pocket, divided by the $7.30 of maintenance requirement, gives you a 9.6% return on capital if this expires worthless. It had an 80% implied volatility rank, and that just looks at volatility over the prior year, ranks it from 0 to 100, and that's what gives us the high premiums. And we love selling high premium, always with the charts of course, because then we're getting paid more for selling this out of the money put. With IYT being at 185 and change, it can fall over $11 to our short strike, and we still make maximum profit. Assume you sold a 10 lot of this, then that would be $700 that is immediately deposited into your account. We actually closed this trade the following day. We put this on last Thursday. We closed it out yesterday for 55% of maximum gain. So we eliminated 21 more days of risk because we've booked the meat of our potential gain in one day and avoided any further risk. We profited from that. So even though we sold a 22-day out, once we're in a position, we're in trade management mode. We're trailing stops. We're taking partial profits. We're managing per the charts. But the reasons that we were able to book 55% of our gains in one day was for these three Greeks, they're called. But let's just keep it simple. The stock moved up the following day. So we profited from the directional move, which is referred to as delta. We profited from time decay. Not so much because we were only in it one day, but that's the idea of selling credit spreads, is because as long as the stock just chops around or moves in the intended direction, we're going to make money day by day because of the melting ice cube nature of people buying options. We're taking the other side. We're selling those options. Finally, volatility contraction. While the stock is tanking, volatility is rising. So with the bottoming tail and yesterday's bullish move off this bottom, volatility contracted, and that's what was giving us gains through Vega. One more example, and we could go on and on. Our weekly options trader specializes in selling these credit spreads and naked options with 10 days to expiration or less. And here's another one that we put on Thursday. A bullish engulfing, we call this a 180 reversal, an ugly red bar, followed in the very next bar by a bullish green bar. We have the rising 50-period moving average. We have a lot of support in here. So we're just going to sell an out-of-the-money put. We sold the 30. We bought the 25 to limit our risk and maintenance requirement. Took in 60 cents a share. On a 10 lot, that's 600 bucks goes into your account. The return on capital on that one, 60 cents divided by the 440 a share, 13.6% return on capital if it expires worthless, which is above 30 bucks in 21 days. And the other beautiful part that you can never ever say with trading stocks is we have a cushion to be wrong in calling direction. So this stock can go 10.2% against us, we make our maximum profit. That's just a beautiful thing. That's how we get paid, by selling credit spreads around charts to make our weekly and monthly income. If you're serious about wanting to learn how to do what I just showed you in a very brief video with 2 examples, we have this phenomenal course that we just finished. It has 14 modules in great detail. You're going to learn how to get paid predicting where a stock will not go with the proper patterns. Easier to trade than stocks, your regular income, the high probability of profit, and here's that theta, the cushion to be wrong. We're going to show you how to manage these once you're in them properly with adjustment strategies and other trade recommendation tools and tactics. The 14 modules, we have specialty topics on volatility, earnings, gaps, news, ETFs, trading on expiration day, etc. Check it out at mastertrader.com/mastering spreads. And don't forget to subscribe to our YouTube channel if you want to continue to receive valuable information on investing and trading in the stock market. Take care and see you next time.